Right now, silver has two prices. One price exists on screens, charts, and trading platforms. Another price exists only if you want the metal itself. Paper silver is trading around $79 per ounce. Physical silver, metal you can actually take delivery of, is closer to $95. That $16 gap isn't noise, it isn't a dealer markup, and it isn't a temporary inconvenience, because markets can survive volatility, they can survive shortages, they can even survive panic. What they cannot survive is two different truths. And here's the part that should stop you cold. This exact pricing pattern has only appeared a handful of times in modern commodity history. Every time it did, the system behind the paper price failed. Not immediately, not dramatically, but mechanically. The failure always begins the same way, quietly, mathematically, and long before the public notices. And by the time two prices appear, the damage is already done. The silver market isn't breaking. It already broke. What you're seeing now is the signal. To understand why, you have to stop thinking in terms of price movements and start thinking in terms of structure. Because this isn't about silver being expensive. It's about what happens when a market built on promises collides with physical reality. For decades, silver has been priced primarily through paper instruments, futures contracts, unallocated accounts, exchange-traded products, derivatives that represent claims on silver rather than silver itself. Those claims trade freely because most participants never ask for delivery. They roll contracts, they settle in cash, they accept the idea that paper and physical are interchangeable. As long as that belief holds, the system functions. But the moment enough participants want the metal instead of the promise, the illusion begins to fracture. And that fracture follows a pattern so consistent it's almost boring, unless you are living through it. The first phase is dominance. Paper trading expands because it's efficient, liquid, and profitable. Claims multiply faster than physical supply because creating contracts is easier than mining metal. Nothing appears wrong because most trades never touch the real thing. The second phase is stress. Physical demand increases, inventories begin declining, delivery times stretch. But the paper price doesn't respond because it isn't driven by scarcity. It's driven by positioning, leverage, and expectations. That's when small premiums appear. $5, $8, dismissed as temporary. The third phase is where things become visible. Physical metal stops being reliably available at the paper price. Buyers are quoted higher numbers, sometimes much higher. And suddenly, the market has two prices. Not because of speculation, but because paper claims can no longer be converted into physical reality on demand. This is the moment the system reveals itself. The fourth phase is resolution. Either paper prices are forced upward violently to match physical reality, or the system changes the rules and admits, indirectly, that delivery is no longer guaranteed. That's the entire cycle, and it has already played out before. In 1968, gold faced this exact moment. For years, the official price of gold was fixed. Paper claims circulated freely. Confidence remained high until physical demand began draining reserves. As delivery pressure increased, the system tried to hold the price anyway. It couldn't. The result was a two-tier market. One official price on paper and a higher price in the real world. That split wasn't a coincidence. It was the admission. Within a few years, convertibility ended entirely. Those holding physical gold didn't need predictions. The pricing structure told them everything. 3 decades later, it happened again, this time in palladium. The paper market functioned smoothly while physical supply was assumed to be available. Then deliveries slowed, premiums exploded, and for a brief window, futures contracts priced palladium hundreds of dollars below what buyers had to pay to obtain the metal. The paper market said abundance. The physical market said shortage. The physical market was right. Prices didn't drift upward. They snapped. The paper price had no choice but to catch up. Now, fast forward to today, silver has spent decades in a paper-dominated structure. Claims on silver vastly exceed the amount of metal readily available for delivery. That system functioned because delivery requests were rare, but demand has changed. Industrial usage has increased. Investment demand has surged. Inventories, particularly deliverable inventories, have declined. At the same time, the paper market continued trading as if nothing changed. And now, the split has appeared. $79 for a promise, $95 for the metal. That difference isn't arbitrary. It's the price of certainty. It's the cost of stepping outside the paper system. And it's the market as a way of telling you that these are no longer the same asset. This is where the London vaults matter. Not as villains, but as mechanics. Much of the silver stored in major vaulting systems is allocated, already owned, already spoken for. Unallocated silver works on pooling assumptions. Many claims, limited metal, smooth operation as long as delivery requests stay low. But when demand for delivery increases, the system doesn't fail loudly, it strains quietly. Delivery timelines extend. Alternatives are offered. Cash settlement becomes attractive. None of this requires conspiracy. It only requires arithmetic. When claims exceed supply, not everyone can be satisfied at the same price, and that's how two prices are born. The important point isn't whether silver is worth $95. The important point is that $79 no longer clears the physical market. And when a price fails to clear a market, it isn't a price, it's a reference. What happens next is never announced in advance. Institutions don't declare failure. They adjust rules, they redefine settlement, they preserve confidence as long as possible. But the pattern doesn't reverse. The divergence widens. Physical availability tightens. Paper liquidity remains until it doesn't. Eventually, convergence occurs, either through rising paper prices or through explicit separation between paper instruments and physical delivery. Every historical case resolves one of those two ways, and the resolution always transfers value, not suddenly, but decisively. Those holding claims discover limitations they didn't expect. Those holding the asset discover repricing they didn't predict, but benefit from. The two-price moment is the warning. It's the market saying, these are not interchangeable anymore. Silver doesn't need panic to move higher. It doesn't need headlines. It doesn't need belief. It only needs delivery. Because the moment delivery matters more than liquidity, structure beats sentiment every time. Two prices mean one thing. One of them is no longer real. And history is very clear about which one survives.